Good morning, everyone. Firstly, I'd like to express my thanks to all of you for taking the time to join us this morning. This event was originally scheduled to take place at the start of June, but early on in the COVID-19 outbreak, we took the decision, like many of you have equally done with events, to reschedule. However, it is great to be speaking with you, and whilst we are sadly unable to provide you with breakfast, I would like to express my gratitude to those of you who have kept in contact with us and reached out for support or just shared with us what you and your clients are facing. If there is a positive to come from this recent period, we have learned so much about the strength and warmth of our relationships. We have a very full schedule today, and to ensure that we keep to time, we will run through the presentations, and then, once we have finished, we will open up the lines for Q&A. If we do not manage to cover all questions, we will follow up directly. So what have we got in store for you today? Firstly, I'm going to provide a refresh on the key tax considerations in respect to separation and divorce. I would then like to welcome Aniela Bodner to share some topical areas around succession planning and a recap on the proposed inheritance tax reforms, which remain firmly on the horizon. Aniela will be a familiar name to many of you in Yorkshire, and I'm delighted that she joined our now virtual team during lockdown, which is, I am sure, a topic in itself. Wayne Dutton, who is a tax director based in our Manchester office, will provide a run-through on key loss release, which is particularly relevant in a market which is facing challenging valuations. Navigating this topic positively can really provide comfort to clients. Karen Fan will then provide a run-through on the targeted anti-avoidance rules around anti-pheonixism. These rules were introduced in 2016, but are particularly relevant in the current environment. Karen will then be joined by Aniela to provide a refresh on the rules around residence and an overview of the recent changes to exceptional circumstances. Finally, and to bring the presentations to a close, I will provide a summary on the summer economic statement which the Chancellor Rishi Sunak delivered last Wednesday as part of his plan for jobs. I always liken the role that we provide to clients as being there to support them in their most delightful moments, but also in their darkest times. Undoubtedly, during lockdown, personal relationships, well-being and finances have faced unprecedented strain. And stemming from this, we have seen a significant increase in clients seeking support and advice as they consider matrimonial proceedings, many of which involve cross-border issues. This is an area undoubtedly faced by those of you who are focused on family law, with one firm noting a 42% increase in divorce inquiries during April 2020 compared to 2019. Whilst there are very practical issues which require immediate advice for those impacted, it is important that the tax issues are also front and centre. Proactively considering the matrimonial estate tax efficiently can help to mitigate tax leakage, which is ultimately beneficial for both parties. Married couples and those in civil partnerships are deemed as living together unless they are separated under a court order, a deed of separation, or that they are separated in such circumstances that the separation is likely to be permanent. Clearly, there may well be some subjectivity for those couples who have separated but remain living together due to the lockdown restrictions, which is why evidence to support formal separation is important. It is worth noting at this point the need to ensure that parties are actually legally married. The recent case of Akhtar and Khan confirmed that the couple's Islamic ceremony was not valid under English law, such that they were not actually deemed married. As such, whilst this may seem like an obvious statement to make, understanding your client's circumstances is key. Where clients have been married overseas, it is also important to obtain a copy of their marriage contract. Beyond the inevitable changes in personal circumstances, there are relatively limited income tax issues. Ordinarily, jointly held assets are taxed on a 50-50 basis unless a joint declaration has been made of unequal beneficial interests, which is not uncommon with property assets. The spouse paying maintenance does not receive tax relief on the payments made, and they are paid from net income. Equally, the maintenance receipts are not taxable in the hands of the recipient spouse. The exception to these rules for tax relief on the payments made is where the spouse was born prior to 6 April 1935, therefore aged 85 or above. It is worth noting, however, that there can be inconsistencies of treatment with cross-border cases. For example, in the Netherlands, maintenance payments are taxable in the hands of the recipient spouse up to a rate of 50%, and it is therefore important to understand the tax profile of each party at the time of the agreement, and where possible, what their future residence intentions might be. Clarifying when separation occurred is important from a CGT perspective. Couples who are divorcing can only transfer assets between each other on a no gain, no loss basis in the year of separation. For those currently considering proceedings and who separated during lockdown and since the start of this tax year, they will only have until 5 April 2021 to take action. And whilst this may seem like quite a long time to plan ahead for, concluding agreements can take much longer than people realise at the outset, not least in this current environment. Assets will be deemed to be transferred at market value and with reference, where applicable, to connected person rules until decree absolute. It is worth noting that the value agreed between parties is not binding as far as HMRC is concerned, particularly where property or luxury assets are concerned. Where there is subjectivity, an independent valuation should be sought for comfort. For CGT purposes, the date of the contract is the deemed disposal date, unless there are conditional circumstances. Where possible, wider thought should be given to entering into potential contracts in the year of permanent separation if it helps from a tax efficiency perspective. Otherwise, reference will be given to the date of the court order, the date of the decree absolute, or the date of the contract if the asset is transferred by contract. The marital home is often the key capital asset, but with the housing market in a state of flux, realising it might be protracted. The rules around principal private residence relief have been undergoing reform in recent years, and this valuable relief, which allows the sale or transfer of the family home to be exempt from capital gains tax, is an important consideration in divorce proceedings. With effect from 6th April 2020, the post-occupation exempt period, which was originally 36 months, then 18 months, was further reduced to 9 months. And this may place additional pressure on couples who are in the throes of finalising proceedings or realising this asset. For those couples fortunate to have more than one property, which may attract principal private residence relief, including properties from prior to the marriage or indeed from previous relationships, considering how they can be utilised as part of this settlement can create efficiency, and elections may be appropriate. It is interesting to note the number of inquiries which we have had recently in respect of parties who have undertaken agreements, be they measure agreements or deferred charge arrangements. A measure order governs how the family home will be treated after divorce, and whilst they can provide an immediate solution, particularly to preserve continuity and to limit home upheaval where children are concerned, they do, however, present particular tax consequences which can be significant. For the spouse who has left the property but retains an interest, there are settlement implications and future CGT exposure once they receive a share of the future sale proceeds, and the prospect of the additional 3% stamp duty land tax charge on the purchase of a new property. Equally, in this current environment where there is a potential lack of liquidity, deferred charge arrangements may appear favourable, but the future tax considerations may make them tax inefficient, particularly if there are changes to CGT rates in the future. A couple remain married and connected for inheritance tax purposes until their decree absolute is issued. Assuming both parties are UK domiciled, assets can be transferred without inheritance tax exposure until they are divorced. Following this, it is important to be mindful of the risks around potential exempt transfers and if there is gratuitous benefit conferred. However, there are specific exemptions for dispositions for family maintenance. Clearly, from a legal perspective, it is sensible for the couple to consider updating their wills in contemplation of divorce, but also after they have divorced. Their original wills will undoubtedly no longer be reflective of their individual wishes, and wider executors may also need to be updated. I have noted a number of other issues which we frequently advise on during matrimonial proceedings. Sadly, we do not have time to cover them in detail today. However, it is worth noting that the current environment is creating challenges on valuations, and agreeing appropriate valuation methodologies, particularly with private company shareholdings, can be protracted. We have a very experienced valuation and forensic team with whom we work closely with on matrimonial cases, who can provide support and a pragmatic view, particularly where there has been a rapid change in circumstances. Finally, as many family practitioners will note, couples who have previously concluded financial settlements may be seeking to revisit them when personal circumstances have been materially impacted. We are also seeing clients wanting to review previously agreed pre- or post-nuptial agreements, and there are those who were hoping to marry this year and have had their plans sadly postponed. Those in that situation who have had prenuptial agreements should seek advice. With that, I will hand over to Aniela, who will provide you with some insights into inheritance tax.
Thank you, Vanessa. The circumstances and challenges brought about by COVID-19 have sadly made us all aware of our own fragility. This has inevitably prompted individuals to think about providing for loved ones, which has in turn led to conversations about what can be done to mitigate future inheritance tax liabilities. Currently, inheritance tax is levied at 40% on estates valued at the date of death above the available nil rate band, which is currently £325,000. So, what are we talking to our clients about at the current time? Firstly, it's always worth checking that clients have made a will and that it is in line with their wishes. We'd recommend a will is reviewed on a regular basis so that any necessary updates can be made for any changes in circumstances. An effective but sometimes overlooked inheritance tax exemption is for regular gifts made out of an individual's income, which immediately removes the gifted asset from the donor's estate without requiring them to survive the usual 7 years. It's important to establish that there will be a regular pattern of gifts, and we would recommend documenting this in a letter to the recipient. It's also important that the gifts are made without any conditions attached. Times of suppressed asset values can sometimes create opportunities for clients to revisit their planned succession strategies. That could be bringing forward an intended gift or establishing structures such as trusts or corporate vehicles, whilst the resulting CGT and IHT liabilities may be comparatively low. Additionally, clients with existing structures are using this time to reflect on whether they are still fit for purpose, and if not, whether any alterations should be made, for example, in relation to the split of rights or control. If an individual owns an asset that qualifies for agricultural property relief or business property relief, up to 100% of that asset's value may be exempt from inheritance tax on lifetime or death transfers. Under the current law, a business owner may therefore be able to put plans into place for the future ownership of his or her business without triggering any immediate IHT liabilities. It may even be possible in the right circumstances for them to hold over the CGT liability on the resulting gain. Another area of concern at this time is for clients wishing to provide financial support to charities. Lifetime charitable gifts are exempt from IHT and CGT and can even offer an income tax relief depending on the circumstances. On death, a bequest of at least 10% of an estate can result in the IHT rate being reduced from 40% to 36%. The IHT bill on assets inherited prior to the COVID-19 outbreak will be reflective of the probate value, which may be higher than is currently realisable. In that situation, if executors have sold an asset, such as shares in an investment portfolio within 12 months or longer in the case of land, it may be possible to claim an IHT refund on the basis that certain conditions are met. If some assets are sold at a gain and some are sold at a loss, then the IHT refund available will be calculated in reference to the net loss. Investment advice should be taken by any executors who are weighing up whether to sell or hold on to assets. And provisions also exist to pay IHT in equal instalments over a 10-year period on certain assets, for example, land, property, certain shares and securities subject to meeting specific criteria. Potential reforms to IHT have been the source of much speculation, and we anticipated changes in the March budget which did not materialise. There was also no mention of IHT at the Chancellor's summer statement on 8th of July. However, given the significant funding shortfall at the Exchequer, we would not be surprised if potential plans for IHT reforms are revisited. The core of the anticipated proposals were based on the all-party parliamentary group report, which was published in January. Whilst the recommendations are not an indication of the current government thinking, they do stem from a cross-section of MPs, which is perceived as influential, especially as it follows previous Office for Tax Simplification reports. The key points from the proposals are a 10% IHT charge on lifetime gifts in excess of £30,000 each year, the rate of IHT on death to be lowered to between 10 and 20%. Lifetime gifts would not be brought into account on death. The nil rate band with the ability to claim unused spouses' nil rate bands would remain. However, the resident's nil rate band would be abolished. The abolition of most IHT reliefs, including agricultural property relief and business property relief, only leaving the spousal exemption and charity exemption in place. There would be an option to pay IHT on death or lifetime transfers in 10-year instalments for land and businesses. There'd be no tax-free uplift in the base cost for CGT purposes, so for both lifetime and death gifts, the donee would inherit the donor's CGT base cost, meaning any gain would be held over until the donee sells the asset. There'd be an obligation to report lifetime gifts over a de minimis limit. The suggestion here is £10,000. Non-UK domiciled individuals would be subject to IHT on their worldwide assets if they have been UK resident for 10 out of the previous 15 years. There would also be changes to the relevant property trust regime, including replacing the 10-year charge for trusts to an annual charge and bringing capital distributions within the charge on lifetime gifts. These proposals, while substantial, should not automatically be considered bad news. Their impact will depend on a person's individual circumstances. Clearly, the loss of APR and BPR will be a big concern to business owners. However, if the reforms result in higher IHT liability, the payment of tax might be deferred. Furthermore, large non-business estates may benefit from a reduction in the IHT rate from 40% to 20 or even 10%. Given the uncertainties as to the future of IHT, we are seeing clients considering crystallising their existing exemptions by accelerating gifts to the next generation. Our advice would be to consider all aspects to ensure that any decisions are made in a suitably controlled manner. If you'd like to discuss anything in relation to inheritance tax or succession planning, please do get in contact with me or with your usual BDO personal tax contact. I'll now hand over to Wayne, who will provide us with a refresher on some key loss relief.
Thank you, Aniela. As Aniela's just said, and also as Vanessa mentioned right at the beginning of the presentation, it's probably worthwhile just going through a number of loss reliefs that are currently available to clients, particularly individuals, in light of the current economic climate. So some of the losses that I want to sort of discuss with you include capital and income losses, and in certain instances, where there's an interaction between them both. Also, I want to quick look at inheritance tax losses, and there's another number of further considerations which I think is worthwhile mentioning. I should also say that a lot of the things that I'm going to talk about over the next few minutes or so, they're actually quite technical, so I will give you a high-level overview. But if you've got any clients that do could benefit from any of this, then it's worthwhile speaking to one of your professional advisors. So the first thing to speak about is capital loss relief. So this is in essence where someone realises a loss as a result of a disposal of an asset. And the default position is that any loss is set against any capital gains that arise in the same year. And then the net position is then subject to your annual exemption and then taxed at an appropriate rate. If there are any excess capital losses in a year, then these are carried forward and then set against future gains net of your annual exemption. There are, however, instances where capital losses can be set against income. And these are typically losses suffered on shares in an unquoted trading company. And these are typically ordinary shares, will not be things like fixed rate preference shares. The shares that will qualify will typically be those that qualify for Enterprise Investment Scheme or Seed Enterprise Investment Scheme relief. If the shares which have been subscribed for don't qualify for either of those reliefs, then there is a separate set of circumstances which essentially gives you the relief for shares in an unquoted trading business that isn't listed or wasn't listed at the time of issue, and it satisfies a gross assets test. So the gross assets test has changed over a number of years, but since 2006, if the company's gross assets pre-share subscription was 7 million or less, and then post-share subscription is 8 million or less, then there may be an opportunity to claim relief against income. The shares must be subscribed for full money or money's worth, but it is essential that you bear in mind that there are limits on losses suffered on shares subscribed under EIS or CDIS, and the restriction is such that any loss that you suffer is restricted by any income tax relief that's given at the outset. So, for example, if someone subscribed for £100,000 worth of EIS shares and they received £30,000 worth of income tax relief at the outset, then the loss relief subsequently will be restricted to £70,000. That's the 100,000 less the 30,000 relief that was given initially. It's also worth bearing in mind that there doesn't need to be a disposal to claim the loss relief. HMRC do allow what is known as a negligible value claim, and this is where an asset has become of negligible value, and negligible value means worth next to nothing. Historically, we have seen and heard discussions where people consider negligible value to be 5% or less, but that's not actually the case. It does need to be worth next to nothing, and HMRC are actually quite hot on that. They will look at claims and just to make sure that there is actually the assets have become of negligible value. If a claim is made, it can be backdated up to 2 years. That is provided the asset was of negligible value at the date the claim is backdated to. And similarly, if you've got shares on an appropriate asset, you can claim income tax relief in respect of that loss. And an asset would typically be shares in an unquoted trading company. The other area where it doesn't actually need to be a disposal is in relation to loans made to traders. So if an individual has made a loan to a trading company and that loan subsequently becomes irrecoverable, it is possible to claim a loss for the value of the loan that has become irrecoverable. Again, HMRC do look at this in a lot of detail, and that there is particular emphasis on the loan having become irrecoverable. So the key there is to show that when the loan was first advanced to the company, that there was a realistic chance of that being repaid. In terms of the loan itself, the money must be used by the borrower wholly for the purpose of the trade professional vocation of the business, and the borrower must be UK resident, and the debt mustn't be a debt on security. A debt on security is essentially some bonds or debentures. Relief is also available under these provisions for payments made under a guarantee. And it is probably worth stressing that these are two things that HMRC are really hot on looking at and challenging. And I have seen a number of instances where HMRC have challenged these and got into a great deal of detail before the losses have been allowed. If we then move on to income tax loss reliefs, so this will typically be where you've got a sole trader or a partner in a partnership whose business has suffered a loss. The basic position is generally that a loss can be set against other income in the same year or the prior year. That loss could also be set against capital gains of the same year or the prior year. But to benefit from this, you do need to make an election to set the loss against the income in priority. Any losses that aren't relieved in the current or prior year are carried forward and set against future profits of the same trade. In addition to the basic provision, there are other reliefs available which are available in particular circumstances. For example, in the opening year of a business, the losses in the first 4 years may be carried back against 3 years prior to the beginning of the new business. In addition, there are terminal losses. So if a business ceases, then the loss which is generally generated in the last 12 months may be carried back against profits of the same trade of the 3 prior years. It is important to note there that it is the losses of the last 12 months. If a business or a partnership ceases halfway through an accounting period, it may be necessary to look at the results of the business up to the cessation and also take a proportion of the prior year's accounting period and use that to calculate the available loss. In addition, if there's any overlap relief, which are profits, generally profits from an early year which have been taxed more than once, then you can use the overlap relief to inflate your losses available for terminal relief. There's also pre-incorporation losses. So if we've got a business that's been transferred to a company and that business was loss-making prior to the transfer, then those losses are carried forward and set against any future returns from the incorporated business. So those returns could be things such as salary or dividend payments, and that does apply to trade or property businesses. So in addition to having those loss reliefs available, there are a number of limitations on what individuals can and can't do. So in relation to income tax reliefs, the relief is restricted to the greater of £50,000 or 25% of income in each tax year. This restriction doesn't apply, however, to losses set against the same trade. Any capital gains relief, so if you've made a loss and you've made a claim for income tax relief, but you've got some significant gains in the year, the £50,000 won't restrict you from setting that excess loss against those other gains. In addition, if you've suffered losses on EIS or CDIS shares, then the £50,000 or 25% of income restriction doesn't apply. It's also worth mentioning that HMRC will not allow relief for losses from what they deem to be an uncommercial trade, and that's a trade where there is no reasonable expectation of profit. And when you look at the expectation of profit, that's typically looked at over a period of 3 to 5 years. There are instances where HMRC will look at the profit test over the duration of a business, but again, it's something that HMRC are quite hot on, and they will look at these things on a regular and routine basis. With regards to sole traders, you may recall that fairly recently an exemption was brought in which said that if you've got income from a small trade and the profits from that are less than £1,000, then that is exempt from income tax. So the flip side of that is that if you've got a trade and you make a small loss, then a loss of up to £1,000 is also exempt. It is, however, possible to make an election to disapply the exemption and claim relief for that £1,000 loss against other income. In addition to the restrictions on individuals only being able to set £50,000 of losses against their income or 25%, then there are further restrictions for trade partnerships. And these are typically limited partnerships or LLPs, where the sideways loss relief is restricted either to the amount of capital contributed or an annual cap of £25,000. If we move on quickly to inheritance tax loss reliefs, as Ella mentioned earlier, there are a number of reliefs available, and these particularly relate to an estate which has suffered a loss on the sale of shares. So those shares need to be sold within 12 months of death, and they would need to be shares that are listed on a recognised stock exchange. If you do suffer a loss in terms of that disposal compared to probate value, that loss can be used to reclaim inheritance tax paid at the time of death. Similarly, there is a relief available on the loss and sale of property, and if this disposal takes place within 4 years of death, then it is possible to go back and recalculate your inheritance tax based on the value of the proceeds as opposed to probate value. It is worth bearing in mind, though, that the value of the property must reduce by the lower of 5% or £1,000. It is also possible to pay inheritance tax in instalments on certain assets, which are typically illiquid. These will be things such as houses and shares in an unlisted company. This slide shows some of the things that we are seeing and which is quite topical at the moment. We have seen the government and HMRC be quite amenable in terms of people who are suffering financial difficulties as a result of the COVID-19 pandemic. What we don't know is how HMRC's attitude will sort of move on should people start making claims for losses, for capital losses, negligible value claims, loans to traders. That will be something that we'll need to keep an eye on. In terms of spousal transfers, it is worth bearing in mind that if you've got spouses who have an interest in property or investments, if one spouse suffers a loss and the other suffers gains, there is no way to combine those. So there are opportunities to transfer assets between spouses to make sure that you've got the gains and the losses arising in the same place to maximise relief. There is targeted anti-avoidance there is a targeted anti-avoidance provision which does avoid or stops individuals claiming loss relief if they've done a transaction which is uncommercial. We do not anticipate that this target anti-avoidance rule will apply to disposal transfers, and HMRC did seem quite comfortable with that in discussions, but it is worthwhile bearing in mind that it is something that could be challenged at some point in the future. In terms of clogged losses, this is a loss that arises between two connected persons. For example, father giving shares to son or daughter, or there being a transfer of assets into a trust. The rule in relation to clogged losses is that those losses aren't available for relief unless there is a transaction between the same persons which gives rise to a gain. With regards to earnouts, because of the way things are currently valued, it is possible that people who have received earnouts may not receive the payments that they were anticipating, and it may be that in earlier tax returns they put a larger value on there in anticipation that they would receive this payment. It is possible to claim relief for any shortfall in any earnout payments, so it is worthwhile looking at past transactions and speaking to clients to see if there's anything there that can be claimed. In relation to property losses, these are typically carried forward and set against future profits from a property trade, but it's also worth bearing in mind that the £1,000 exemption, which I mentioned earlier in relation to trading businesses, that also applies to property losses. So if you've got a client who has suffered a relatively small loss as a result of a property business, there is an opportunity for them to elect out of the new provisions and claim relief for that loss, albeit it may just be carried forward for future years. And then it's also worthwhile mentioning the general anti-abuse rule, which essentially says that if someone does something which is against the intention of the legislation, then any losses or any reliefs that will crystallise as a result of that will be disallowed. So the key message there is, if people are looking at their affairs and looking to crystallise losses, it is essential that any losses that they crystallise are commercial. Otherwise, they do risk HMRC looking to disapply or not allow any relief for those losses. I'm happy to take any questions at the end of the presentation. It's worthwhile mentioning that I think documentation in terms of a lot of these things is key. But what I will do now is hand you over to Karen, who's going to speak about the anti-pheonixing provisions.
Thank you, Wayne. We thought it'd be useful to provide a refresher on the targeted anti-avoidance rules, which is also known as the TAR. The reason for this is that in this current environment, there may be some businesses that will suddenly have to cease to trade for a number of reasons. And we've seen this to apply in a number of circumstances besides commercial reasons, such as marital and family disputes and reorganisation of businesses. And we are seeing a lot more activity in this area. The TAR was introduced with effect from the tax year 2016-17, and therefore the provisions applies on any distributions made from a company on or after the 6th of April 2016. The provisions were introduced to prevent individuals lowering their tax liability by converting what ordinarily would have been a dividend, which would be subject to income tax of up to 38.1% if the individual was an additional rate taxpayer, into a capital payment, which would be subject to capital gains tax, currently at 20%. And in some circumstances, if entrepreneurs relief applies, they could claim the first 1 million taxed at 10%. Therefore, the tax saving from a capital payment versus an income payment could be up to 28.1%. The TAR was introduced to tackle the tax advantages which can arise from pheonixing, and this is where the individual shareholders liquidate a company and then set up a new company to carry on as much of the same activity as before. However, the scope of the TAR legislation goes beyond this and has the potential to apply in a much wider range of scenarios, and I will briefly mention a few of those later. So for the TAR provisions to apply, there are 4 conditions, and where all four conditions are met, the effect of the TAR is to treat the liquidation distributions to the shareholders that they receive as dividend income, which is subject to income tax and not as a capital distribution. So what are the conditions? Well, broadly, conditions A and B are based on the background of the company and its shareholders. Condition A is where the individual receives a distribution, holds at least 5% interest in the company immediately before the winding up. Condition B is where the company is a closed company at any point in the 2 years, ending with the start of the winding up. Both these conditions in practice means that mostly owner-managed businesses, family businesses, property and family investment companies are within the scope of the TAR. It is the interpretation of condition C and D which will need more attention. As shown on this slide, condition C is met where the individual who receives the distribution in a winding up or is carrying a trade or activity which is the same or similar to the trade or activity carried on by the company, and the individual or person connected with them or is a participator in the company is involved with the carrying on of such a trade or activity. In summary, condition C requires a lot more thought. It requires consideration as to whether the two trades and activities are the same or similar, and whether the individual is involved directly or indirectly in the continuing trade. These terms are not clearly defined in the legislation. However, it should be noted that the terms involved extends beyond the traditional pheonixing and can include whether trade is carried on personally, by a connected party, or through a partnership or company. HMRC manuals do provide some examples, and I've listed a few on this slide. As you will see from the slide, the first scenario refers to Mr. G, who is a sole shareholder of a company and runs a car washing service. Mr. G decides to wind the company up, but continues to carry on the same activity, but via a partnership structure with his wife. And as part of that, he also starts to sell air fresheners. Clearly, Mr. G is carrying on the same trade, or at least a trade very similar to that he carried out by the company, and therefore condition C is satisfied. One of the other scenarios is Mrs. D. Mrs. D, a recruitment consultant, runs her own business through a company, and after 3 years of training, part-time in IT, she decides to wind up her company and starts a new company that offers her services as an IT consultant. Some of her new clients are businesses she's dealt with in her previous company. In this scenario, although Mrs. D is still a consultant, the trade has considered to be significantly changed, and it is unlikely that it will be viewed as the same or similar to that trade carried on by the wound-up company. It doesn't matter that she's dealing with some of the same clients before, because the nature of the service she's providing is different. One of the final examples given is with regards to Mrs. F. Mrs. F is a landscape gardener via a limited company. She decides to retire and wind up the company. However, to supplement her pension so she can still enjoy her luxuries in life, she decides to provide routine gardening services for a small group of clients in her local village as a sole trader. It is unlikely that Mrs. F is carrying the same trade after the wind up of the company. However, the provisions of gardening services is similar to the provisions of landscape gardening, and therefore in this instance, condition C is also likely to be met. But that doesn't mean that the TAR will apply to the distribution, because all 4 conditions need to be met. And therefore, we need to consider condition D, which I will go through now. Condition D, it is reasonable to assume that the main purpose, or one of the main purposes, of the winding up is the avoidance or reduction of a charge to income tax, or the winding up forms part of an arrangement, the main purpose, or one of the main purposes of which is the avoidance or reduction of a charge to income tax. There are a couple of exclusions which are noted on this slide. HMRC's view is that condition C is drawn intentionally wide, and it is the condition D that acts to narrow the scope of TAR. Unhelpfully, HMRC guidance provides very few examples to illustrate when condition D may or may not apply, and instead, this is inevitably a question of judgment to be made based on the facts of each individual's client's case. Factors that will need to be taken into account can include commercial reasons. Are special purpose vehicles required for each property venture, for financing and legal requirements? Is the structure to be put in place to ring fence the risk to limit the liability to each property development or business structure? Is it because there are different shareholders or investors in the company? Is there a tax advantage? And if so, what is the quantum, and why is the company being liquidated? To what extent does the trade or activity carried on after the winding up resemble the trade or activity carried on by the wound up company? And what is the individual receiving the distributions involvement in the new entity? And to what extent have their work and practices changed? Are there any special circumstances? It is impossible to provide a full list of examples, and the aim is to establish whether it is reasonable to assume that the company that was being wound up by way of converting a capital transaction, which would otherwise have been paid out as a dividend distribution. Some of the final points with regards to TAR is unlike transactions in securities where you can seek tax clearances from HMRC, that a transaction should be treated as a capital payment and not an income distribution. For the TAR, there is no clearance process. There is a 2-year tail which applies 2 years before the starting of the winding up. If the TAR could apply, it would need to be disclosed on the client's tax return that this applies and full disclosure would be required. If clients and advisors don't think TAR applies, it is really important that the clients collate as much evidence as possible to demonstrate the reason and commercial background to the winding up and the lack of any intentions to continue in the same or similar trade or activities. If it is a property venture, it is really important to document the commercial drivers behind each entity created. Documentation to support the key drivers and commercial rationale for the structure should be maintained throughout the whole process. And this will be key as this will provide good evidence and a good footing to HMRC should they inquire into the position. If there's real uncertainty as to whether the TAR applies, clients should consider making a white space disclosure and clients should take tax advice from the outset prior to their company being liquidated so that they are clear on what their tax position will be from the start. Hopefully this has provided you with an overview of how the TAR could apply in your client circumstances. And please feel free to ask any questions after this webinar, or also please contact your usual BDO contact. The next topic we thought would be good to provide an update on is the statutory residency test. In these challenging times, HMRC have issued new guidance in relation to the statutory residency test and how this will operate as a result of the COVID-19 pandemic, due to the impact it has on an individual's ability to move freely to and from the UK, which may require them to unexpectedly remain in the UK longer than they first envisaged. So a very brief recap of what is the statutory residency test, and in short, we call this the SRT. So from a personal tax perspective, an individual is subject to UK income tax and capital gains tax if they are resident in the UK. Prior to the SRT, the residency provisions were not as clear-cut, and we were guided by HMRC with their booklet, HMRC 6, their guidance and case law. The SRT was introduced from 6th of April 2013, so in effect it took place for the tax year 2013-14. Unfortunately, we're not going to have time today to go through the exact details of each element of the SRT, but if you'd like a separate session on this in a future webinar, then please do let us know. However, broadly, I'll go through the SRT now. The SRT follows a systematic series of tests that must be followed in a prescribed order to determine whether an individual is UK tax resident or non-resident for a particular tax year. We'll look at the test for each individual for each tax year to determine their residency status. Firstly, there are automatic conclusive tests where if you meet a certain criteria, you are automatically a UK tax resident or not resident in the UK. And these are based on circumstances, but also the number of days you have spent in the UK or overseas. A day is counted as if you are present in the UK at midnight. If you don't meet either of these two automatic tests, then we have to look at the number of sufficient ties you have with the UK and the number of days you have spent in the UK. Ties include family, work, available accommodation, and if you've spent more than 90 days in the UK in the last 2 tax years, and if you've spent more days in the UK than any other country. We also need to consider this on an individual by individual basis. So each spouse would be determined on their SRT on their own. In summary, the more times you have with the UK, the less days you can spend in the UK without becoming a UK tax resident. And this will also depend if you're an arriver or a leaver, being if you've been in the UK, being if you've been UK tax resident in the previous 3 tax years. I will now hand over to Aniela, who will cover some of the changes announced as a result of the COVID-19 pandemic.
Thanks, Karen. With the travel restrictions and quarantines in place, individuals have been unable to move freely to and from the UK in recent months. People may therefore have had to stay longer in the UK than they had planned. The SRT provides some relief for certain situations where an individual would not be present in the UK at the end of a particular day, but for exceptional circumstances that are beyond his or her control, which prevent him or her leaving the UK. If claiming an exceptional circumstance, The individual must subsequently leave the UK as soon as possible. HMRC are known to test this in their residence inquiries. There's also a limit of 60 days of permissible exceptional circumstances in a tax year. The existing legislation tells us that exceptional circumstances include national or local emergencies such as war, civil unrest or natural disasters, or a sudden or life-threatening illness or injury. A key question from our internationally mobile private clients is therefore whether COVID-19 would count as an exceptional circumstance for the purposes of counting their UK days under the statutory residence test. HMRC published guidance in March confirming that where an individual is unable to leave the UK as a result of COVID-19, this would fall within the exceptional circumstance definition, where this is due to being quarantined or advised by a health professional or public health guidance to self-isolate in the UK as a result of the virus, or being advised by official government advice not to travel from the UK as a result of the virus, or being unable to leave the UK as a result of the closure of international borders, or being asked by your employer to return to the UK temporarily as a result of the virus. Whilst this was welcome news, the 60-day annual limit seems somewhat short given the length of time coronavirus-related travel restrictions have persisted. Also, it's unfortunate that exceptional circumstances do not apply to all of the day counting tests within the statutory resident test. So great care is needed and special advice is recommended if individuals are expected to rely on having an exceptional circumstance. For example, if an individual is only in the UK as a result of an exceptional circumstance, but if they do work on those exceptional days, then those UK work days would not be disregarded when analysing whether that individual had a work tie under the sufficient ties test that Karen mentioned. Depending on the specific circumstances, these nuances may lead to an individual being treated as UK resident despite only being present in the UK because of the pandemic. Concerns such as this were highlighted to the government, and in Finance Bill 2020, which is currently going through approval but will be retrospective to 1st of March 2020, the UK government has gone some way to relax a number of the SRT's unwelcome results. The relaxations apply to certain tests which count days in the relevant period. Now, the relevant period is currently drafted as being from 1st of March 20 until 1st of June 20, but that may be subject to review if these coronavirus restrictions persist longer term. For any relevant period spent in the UK, days and ties will be disregarded when applying the SRT's test. So that means that days are considered as neither spent in the UK nor spent overseas. And any UK ties created as a result of the individual's physical presence in the UK in the relevant period are ignored for the purpose of the sufficient ties test. Additionally, when considering the automatic UK test where a person has a home overseas, the home test will have no effect in the relevant period. In all other respects, the tests apply as normal outside of the relevant period. These legislative changes apply when determining an individual's residence position for the 1920 tax year and also for the 2021 tax year, provided the individual was not UK resident in 1920. If we think of an example of these legislative changes, when we consider the UK work tie under the sufficient ties test, a day in the relevant period can be disregarded if the individual is in the UK to carry out specified coronavirus disease-related work and is otherwise resident for tax purposes in another country in accordance with the laws of that territory. Now, coronavirus disease-related work means as a medical or healthcare professional for purposes connected with the detection, treatment or prevention of coronavirus disease, or for purposes connected to the development or production of medical products, including vaccines, devices, equipment, or facilities related to the detection, treatment, or prevention of coronavirus disease. The result of the Finance Bill 2020 changes is that individuals meeting the prescribed conditions may be able to avoid becoming UK residents. that would prevent them from being subject to UK tax on their worldwide income. Instead, only their UK source income would be taxed in the UK. However, these legislative changes do not fix every coronavirus-related circumstance. For example, if an individual cannot leave the UK and chooses to work here remotely, but if their work is not specifically related to the coronavirus medical response, then they will not be entitled to disregard their UK work days when considering whether they have a work tie under the sufficient ties test. Furthermore, if an individual stops doing work related to coronavirus but remains in the UK, the SRT would apply in a normal way to assess the impact of those later days. We wanted to use today's session to highlight this aspect, being unexpectedly required to work in the UK during the pandemic. But when we're asked to consider a real-life individual circumstances, each aspect of the statutory residence test would need to be analysed to determine the person's residence position. We'd start by analysing the normal rules, overlaying the impact of any exceptional circumstances, and also taking into account the Finance Bill 2020's temporary relaxations. If you have any individual clients who are concerned about their UK resident status, we'd recommend they seek personal tax advice at the earliest opportunity. They need to self-assess their residence position on their 1920 tax returns, which are due 31st of January 2021. And if HMRC inquire into the position taken, it would be important for the individual to have kept records and any supporting documentation, including the justification behind any exceptional circumstances or disregarded days. If you'd like any further details about the statutory residence test and the impact of coronavirus, please do get in touch with us. I'll now hand over to Vanessa, who will summarise the key measures from last week's summer economic statement.
Thank you, Aniela. So to wrap up, I will provide a brief overview on some of the key statements which the Chancellor delivered last Wednesday at his summer economic update, which was titled The Plan for Jobs. His speech was focused on creating employment opportunities and reinvigorating distressed sectors. Whilst I would like to end on a positive slant, the backdrop to these proposals are a predicted significant reduction to the global economy of 4.9%, which is a contrast to the pre-COVID-19 situation of an anticipated growth rate of 3.3%. Certainly from our perspective, there were limited private client-focused changes, but the wider context is that all sets being proposed and the impact on growth in the economy and providing a positive platform impacts on all of us. From below, I'd like to pick out in particular the temporary increase in the 0% stamp duty land tax threshold for residential property purchases in England and Northern Ireland, which was increased from 125,000 to 500,000. This was effective from the 8th of March and runs until 31 March next year. This measure will certainly be encouraging for those either looking to get onto the property ladder or making their next move. These measures are expected to help 90% of those looking to buy properties and will provide a £15,000 saving on a £500,000 property purchase. To pick up on Aniela's comment, it may also align with the aspirations of some who are considering inheritance tax planning and would like to support the next younger generation. As the Chancellor's proposed changes to stamp duty land tax apply to properties in England and Northern Ireland, the Scottish Government, which has devolved indirect tax powers, faced immediate pressure to implement similar proposals. The Scottish Finance Secretary, Kate Forbes, responded the following day to say that the 0% threshold for the land and building transaction tax, which is broadly similar to SDLT, will be increased to 250,000 from its current levels of 145,000 or 175,000 for first-time buyers. However, there has been no clarity as to when these changes will apply, as the Finance Secretary advised that the legislation needs to be drafted. The average cost of a residential property in Scotland in 2018-19 was 179,000, and it is anticipated that these proposals will help 80% of Scottish house purchasers. Whilst welcome, there has been pushback that the measures do not go as far as those proposed by Mr Sunak, and with no clarification as to when effective, that they may stall activity in the short term. Please note that the 3% stamp duty land tax surcharge for second properties will still apply. A dual-fold commitment to energy was also announced, which is intended to help the UK meet its net zero gas emission target by 2050, but also to stimulate employment. There are a variety of measures, including a £2 billion green homes plan for landlords and homeowners, facilitated by accessing up to 5,000 of energy-efficient measures per household, or 10,000 for those on the lowest income, and that will apply in 2020-21. It is hoped that this support will create over 100,000 green jobs, and it is expected to facilitate the upgrade to 600,000 homes. I will address the wider VAT and employer matters separately. We have already seen other countries seek to boost consumer spending via specific VAT reductions, and the Chancellor followed suit by announcing a widely anticipated reduction to VAT from 20% to 5% with effect from yesterday, the 15th of July, which runs through until the 12th of January 2021. The reduced rate applies to the supplies of food and non-alcoholic drinks from restaurants, bars, cafes, and similar premises. Equally, the reduced rate also applies to the supplies of accommodation and admission to attractions, and is hoped to support the badly affected hospitality and leisure sectors. Whilst these measures are undoubtedly welcome, the implementation is complex, and fundamentally, consumer confidence will be driven by comfort around personal health. There will be practical challenges, including system changes, and it remains to be seen if the VAT reduction will be passed on to consumers. Administratively, there will be challenges for VAT reporting periods, particularly where there is an overlap of both rates. Equally, with some renewed activity since lockdown measures started to be relaxed, there will be the need to address pre-booked and paid-for suppliers which are at the 20% rate. It is expected that the measure and the Eat Out to Help Out measure will cost £4.6 billion, but with over 2.4 million workers in this sector, accounting for 8% of the UK workforce, the majority of whom have been hit hard by the pandemic, the hope is that businesses and jobs will be protected. There were no changes put forward regarding the coronavirus job retention scheme, which has been accessed by over 1 million employers and 9 million workers, accounting for a quarter of the UK workforce. It was reconfirmed that the scheme will be fully phased out by the end of October. To hopefully mitigate against wide-scale redundancies as the CJRS is withdrawn, a one-off £1,000 job retention bonus will be funded for every furloughed employee who are paid a minimum of £520 per month and who remain continuously employed through to the end of January 2021. In supporting the next generation of workers who have lost jobs or who have yet to access the job market, the Chancellor's Plan for Jobs introduced the Kickstart Placement Scheme to rethink entry-level roles by providing a £2 billion fund to subsidise placements for 16 to 24-year-olds who are facing an immensely challenging jobs market. These measures include payments of either £1,500 to £2,000, depending on age, to employers for each new apprentice hired between 1 August 2020 to 31 January 2021. More broadly, various funds have been established for jobs and research to accelerate infrastructure projects, which is hopes will boost productivity and employment across sectors and regions. Finally, the Chancellor closed by confirming that the third phase of the government's plan will be set out in autumn, with measures to follow which will support longer-term recovery through a budget and spending review. These measures will no doubt evolve, but with unparalleled levels of spending to support the economy and increase government debt, there will be much conjecture and scrutiny as to how these incentives will be funded, particularly when the Conservative manifesto pledged a triple lock on income tax and VAT and NIC for 5 years. It is worth noting that whilst not covered in his summer economic statement, on Monday the 13th of July, the Chancellor wrote to the Office for Tax Simplification requesting that they undertake a review of capital gains tax and the aspects of taxation of chargeable gains in relation to individuals and smaller businesses. His request is for a simplification, but also to identify opportunities in relation to the administrative and technical issues where the current rules may lead to distorted behaviours. In particular, he requested their recommendations and proposals in respect of how allowances, exemptions, the treatment of losses within the scope of capital gains tax, and the interaction of how capital gains are taxed compared to other types of income. Clearly, the latter could be seen to be a line in the sand to address the arbitrage between the lower capital gains tax rates compared to income tax rates, and we will await further details and keep you informed as this and any consultations progress. That concludes our presentations, and I hope we have left you with some positive food for thought. I would like to thank for your attendance, your continued support, but importantly, the personal contributions today from Wayne, Karen and Aniela. Our next event will be on Thursday, the 10th of September at 9 a.m. Sadly, not the late afternoon event followed by drinks on the rooftop of our Leeds office, which we had planned. However, when time is appropriate, we look forward to meeting up in person, and do feel free to get in contact if you or your clients have any queries. We will now briefly pause for any questions. Please dial in using the details from the WebEx operator and on screen.
So we've had a selection of questions sent in, and we'll run through as many as possible and then follow up directly on any which we do not have time to cover today. If there are any additional questions as they come through during the chat, then we will absolutely pick those up as well. The first question that we've had was a query on divorce. And the query was such that if there is a transfer of guilt or bonds between party on divorce, does this give rise to an income tax charge? And in short, yes, it would. An income tax charge would crystallise under the accrued income scheme provisions, and there is no exemption from this charge for transfers between spouses even during lifetime. And then next we have a not uncommon question on pheonixing. So Karen, very often we see property investments structured via a corporate special purpose vehicle, which will be liquidated at the end of the project. The investors may then go on to make a new investment with a new special purpose vehicle, or they may have a number of ongoing projects via separate SPVs. Could the pheonixing provisions apply on liquidation of the SPVs?
So potentially, yes, it would apply in the face of it, because it will probably meet all the four conditions. But the Revenue have acknowledged that in their discussions that if there is a commercial rationale with regards to the arrangements that have been put in place, such as we mentioned before, whether it be for legal reasons, from a risk perspective, from a finance perspective, the different groups of investors, then the Revenue may not look to apply the pheonixing provisions, provided there are commercial reasons for the separate SPVs. I should appreciate the rules are still relatively new and we're still gaining more experience in this area.
Thanks, Karen. That's really great. Aniela, you're up next. So with all the tax deferrals offered by HMRC, has there been anything put forward in respect of inheritance tax? And if not, could you provide a reminder for us as to when inheritance tax is due and payable, please?
Yep, sure. So where inheritance tax is due, it has to be paid to HMRC by the end of the 6 months after the individual has passed away, unless it relates to an asset that's eligible for 10-yearly instalment payments. But beware that interest may be due on the instalment payments in that case. The other thing to mention, I think, is that at the moment with the pandemic persisting, HMRC aren't currently accepting payments by cheque. So you have to do a bank transfer of inheritance tax payments. But hopefully those restrictions will cease as lockdown restrictions begin to ease.
Thank you, Anna. Wayne, if you wouldn't mind picking the question on stamp duty land tax, we only briefly touched on it today, but would you mind clarifying when SDLT is payable and have the payment terms for that also been extended?
Oh, that's an interesting question, actually, because the tax payment date for SDLT was recently reduced to 14 days, or payment within 14 days of completion or substantial completion of the contract. As far as I'm aware, there haven't been any changes to this as a result of the pandemic, and I suspect this is probably for one of two reasons. One is that when people are going into a property transaction, that they tend to budget for the SDLT that's payable, and also because certainly the housing market has been very flat throughout the pandemic. There's been very few transactions anyway, so maybe there was a thought within sort of government that there's no need to do anything in relation to extending this 14-day payment period.
Thank you, Wayne. That's really helpful. Daniela, would you mind if I came back to you? We've got another question on inheritance tax, which is clearly a very popular topic at the moment. Picking up on cross-border issues, we've been asked, my client is a non-UK resident expat. Is he outside the scope of inheritance tax?
That's a good question, and it's something that often comes up. The answer depends on the individual's domicile status, not his residence status. Domicile is a concept we could probably have a whole topic on in a later webinar, but broadly, if the individual was born in the UK to UK parents, and if he has not permanently severed all his ties to the UK since he moved abroad, then he would remain domiciled in the UK, even though he now lives abroad. And in that case, he would be subject to UK inheritance tax on his worldwide assets. I guess the other alternative is that if the individual is not UK domiciled, whether he was born outside the UK or whether he obtained a non-UK domicile of choice since moving abroad, i.e. permanently severing his ties to the UK, in those situations, if he's non-domiciled, then he would only be subject to UK IHT on his UK assets, and his non-UK assets would be outside the scope of IHT. That's a general rule. As always, there are some tweaks around the edges and anti-avoidance provisions that can bring a non-UK domiciled individual's non-UK assets into the scope of inheritance tax. So, for example, from 6th of April 2017, if a non-UK company holds UK residential property, then the value of the company attributed to that UK residential property would be within the scope of inheritance tax for a non-domiciled shareholder. So, as always, there's a general rule, and then you have to look at the details and see the specifics of the assets in question. And then I guess the other thing to mention is that if he is resident abroad, where is he resident? What are the tax laws of that jurisdiction? That would need to be considered as well. But of course, we have global member firms across the world at BDO. So if you do have a client that needs non-UK tax advice, then we can find an appropriate contact for you as needed.
Thank you, Aniela. That's really helpful. It is a very complex area. Karen, just picking up on the topic which you and Aniela covered in respect to the SRT and the need for appropriate documentation, what would you recommend that an individual retains to evidence the work which they've done and where they've done that work?
So they'll need to keep a log of the nature and duration of the work activities, what work they're doing. That can be by way of a work diary or a timesheet. They'd also need to keep a record of when they're on holiday or whether there's any periods of leave or absence where they're off sick or off poorly and the reasons behind this. Similarly for any other break from when they're working. It'll be helpful if they kept close to hand their employment contracts, including any changes to the terms. That's a good idea to keep. Details of any travel arrangements, travel plans, and if there's any changes, what are the reasons for these changes? They just need to also think about, with regard to the SRT, does their travel arrangements impact this? Does it impact the other tests or ties? Whether it would make them actually resident or not? And just any other additional, records would be really helpful to evidence any judgments that they've made. There are a few HMRC manuals available online which give more examples of the relevant documentation that should be kept to evidence an individual's residency status. So if anybody wants any help in locating those manuals, then please let me know after this webinar.
Thanks, Karen. I think what both you and Aniela covered around the SRT, particularly for those individuals that might be in the UK or not be where they intended to be due to the exceptional circumstances situation that they're facing, that I think it's going to be very important that they do keep appropriate records. And if you wouldn't mind, can I just stay with you because we've had another question which picks up on the pheonixing section that you covered. So how does the targeted anti-avoidance rules, the TAR rules, interact with the usual HMRC clearance process for company reorganisations?
So there is no clearance process for the TAR. So if it's a reorganisation, normally you go for clearances either under transactions and securities and the share-for-share exchanges. So you would still go for clearances under that basis for transaction securities and share-for-share as normal. But for TAR, it isn't covered by those clearances. The TAR is more self-assessed. So the revenue is still considered TAR to be the relevant transaction to be caught within the TAR. That is for up to the individual to self-assess it on their tax returns. We're not aware that the revenue are going to introduce a clearance process for TAR. So it is two separate matters there.
Thanks, Karen. I think that's a very important point just to clarify. And if people are concerned about that, then do please get in contact. So finally, and to close, we've been asked a very open question in respect of the thoughts on the proposed, or our thoughts on the proposed simplifications to capital gains tax following Rishi's request to the Office of Tax Simplification for a review. It's a very open question, is that? And whilst we'll clearly see how this evolves, and the content of the review is quite wide-reaching when you actually look at the underlying documentation, I think it's worthwhile noting that UK taxpayers have already seen further complexity added to an already complicated system. And with some fundamental changes to CGT already this year, in particular around the reduction of the scope of entrepreneurs' relief and 30-day reporting of gains on residential property. A further review to simplify the system is undoubtedly welcome, but with such a broad scope for change, it's crucial that the government does take time to absorb all of the information and recommendations it will receive as part of this review, and also the interaction with other taxes. And obviously our preference would ideally be for them not to rush into announcing any changes in the autumn budget, but for them to be very well considered. That brings to an end the questions that we've received directly so far this morning. And so with that, we'll bring this event to a close. The recording will be shared in due course. And as mentioned, our next event will be on the 10th of September. However, there is a variety of other events that, as a firm, BDO is running, and I would encourage you to engage with those as much as possible, to share them with your clients, because there's a huge amount of information out there to help individuals and to help businesses, particularly during this difficult period. So please do get in contact with any of today's speakers or with your usual BDO contact should you do have further queries. But as ever, we will aim to share with you any key updates as they arise.